2026 is already showing us that gold and silver aren't just reacting to market forces anymore. They're being driven by geopolitical chess moves that most investors don't even realize are happening. If you've been following precious metals, you know we're witnessing something extraordinary. Gold and silver just closed out 2025 with historic gains. Silver was up roughly 150%, its best year since 1979. Gold hit all-time highs, but here's what's critical to understand. This isn't a speculative bubble driven by retail FOMO. This is a fundamental restructuring of how major powers view strategic resources. Today, I'm going to break down the geopolitical forces driving precious metals in 2026, why traditional analysis is missing the bigger picture, and what historical patterns tell us about where we're headed. This goes far deeper than supply and demand. We're talking about war cycles, strategic resource control, and the death of the old monetary order. Let's dig into what's really happening. Let me start with something most precious metals analysts completely ignore. War cycles. According to long-term cyclical analysis, 2026 is what's called a panic cycle year for geopolitical conflict. This isn't just volatility. A panic cycle means both extremes get hit. You see massive moves in both directions that take out previous highs and lows in the same year. Here's why that matters for gold and silver. Geopolitics, not inflation, is the primary driver of precious metals prices. Look at the historical evidence. Gold went from $100 to $400 between 1976 and 1979, a steady rise. Then in the final 6 weeks of 1979 into January 1980, it rocketed from $400 to $875. Why? Russia invaded Afghanistan. That wasn't inflation. That was pure geopolitical panic. From 1980 to 1999, inflation went up, national debt went up, and gold went down. So clearly the gold as an inflation hedge narrative is incomplete at best. What actually drives gold and silver to extreme valuations? War and geopolitical instability. And right now, we're seeing geopolitical tensions accelerate at a pace we haven't witnessed since the Cold War. The recent military action in Venezuela isn't primarily about oil or drugs. It's about strategic positioning and resource control. Here's what most analysts are missing. This was essentially a repeat of the Cuban Missile Crisis. Reports suggest Russia was considering placing missiles in Venezuela and Cuba, which would put them within range of Washington, D.C. That would be Russia's checkmate move against NATO expansion in Ukraine. The Trump administration moved decisively to neutralize that threat by removing Maduro and installing oversight while leaving the government structure largely intact. Why keep the government intact? Because China is Venezuela's #1 oil customer and holds tens of billions in Venezuelan debt. This is the geopolitical tightrope. Neutralize the Russian threat without completely cutting off China, which would be strategically catastrophic. It's classic great power competition. Every move has to account for multiple players on the board. And here's the key insight. People on the inside knew this was coming. How do we know? Because gold and silver started rising before the general public understood what was happening. When you see metals moving ahead of major geopolitical events, that's sophisticated money positioning in advance. They're not reacting, they're anticipating. Understanding the Venezuela situation through the lens of the Cuban Missile Crisis is critical because it reveals the actual strategic stakes. In the original 1962 crisis, Khrushchev placed missiles in Cuba. The deal that resolved it, which was hidden for nearly 20 years, was that Kennedy agreed to remove Jupiter missiles from Turkey. It was a strategic trade, missiles out of Cuba in exchange for missiles out of Turkey. Venezuela 2026 is the same dynamic. Putin hinted at placing missiles in Venezuela and Cuba as a counter to NATO positioning weapon systems near Russia's borders in Ukraine and Eastern Europe. By moving into Venezuela, the US eliminated that bargaining chip before Putin could fully play it. But it also sets a dangerous precedent. If the US can conduct regime change operations for strategic security reasons, Russia and China can claim the same justification for their actions. This is why 2026 is shaping up as a panic cycle year. The rules of international conduct that held since World War II are breaking down. And when the rules break down, uncertainty explodes. Uncertainty drives safe haven demand for gold and silver. Now let's talk about something that's flying completely under the radar for most investors. China's quiet accumulation of silver and strategic positioning. As of January 1, 2026, China implemented export restrictions on refined silver. China controls approximately 60 to 70% of global silver refining capacity. Even silver mined in Mexico, Peru, or Australia often goes to China for refining before being shipped back to Western markets. Those exports are now restricted to state-approved refiners meeting specific criteria. What does that mean in practice? China is hoarding refined silver. But it goes deeper. For the past 2 years, China has been going directly to Mexico and Peru, the #1 and #3 silver producers globally, and buying silver in doré form, unrefined bars, and concentrate, the byproduct sludge from mining. They're paying double what Western buyers will pay, shipping it to China, and refining it domestically. This is called disintermediation, cutting out the Western pricing system entirely. They're not buying at COMEX prices. They're securing physical supply upstream before it ever hits the exchanges. Why would China do this? Because silver is absolutely critical for their industrial and technological strategy. It's required for electric vehicle production, solar panel manufacturing, 5G and telecommunications infrastructure, robotics and automation systems, and military electronics and defense systems. China understands something most Western investors don't. Silver isn't just a precious metal, it's a strategic industrial resource with no viable substitutes for most applications. Both the United States and China have now officially designated silver as a critical strategic mineral. The European Union did the same back in 2023. Think about what that designation actually means. Governments are formally acknowledging that silver is essential for national security and economic competitiveness. This isn't market participants deciding silver is valuable. This is sovereign nations saying they will ensure domestic supply, build strategic stockpiles, and potentially restrict exports regardless of market prices. When major economic powers all designate the same commodity as strategic, you're watching the transformation from a market-priced commodity to a geopolitically controlled resource. And here's the critical insight. Strategic resources don't trade purely on supply and demand anymore. They trade on access and control. Let's talk about silver supply, because understanding this is absolutely crucial to understanding where prices can go. Of roughly 850 million ounces of silver mined annually, only about 160 to 170 million ounces comes from primary silver miners, companies actually mining silver as their main product. That's less than 20% of total supply. The remaining 80% plus is byproduct of mining other metals, primarily copper, lead, and zinc. Silver is found in what geologists call epithermal deposits near the surface. The big, easy deposits have been mined out. Now, most silver is discovered accidentally while mining other metals. Here's why this matters. You cannot simply mine more silver when prices rise. Silver production is tied to the economics of base metal mining. Even if silver hits $150 per ounce, production won't meaningfully increase unless copper, lead, and zinc mining also increases. This is inelastic supply. Supply that doesn't respond to price signals the way normal commodities do. Now pair that with inelastic demand. Solar manufacturers, EV producers, electronics companies, defense contractors, they need silver regardless of price. They can't just stop production lines and wait for prices to drop. You have inelastic supply that can't increase quickly, inelastic demand that won't decrease, major producers restricting exports, governments designating it as strategic and building stockpiles, and sophisticated institutions taking physical delivery in record amounts. This is not a recipe for lower prices. This is a recipe for a structural supply crisis. While everyone's focused on gold and silver, there's another precious metal that's setting up for potentially explosive gains: platinum. The platinum-to-gold ratio recently hit a 23-year low. Think about what that means. Platinum is trading at historically extreme discounts relative to gold. Why is platinum so cheap? Primarily because automotive demand for catalytic converters has been weak and industrial demand hasn't compensated. But here's what's changing. Platinum sources are primarily Russia and South Africa. If geopolitical tensions escalate into actual conflict with Russia, and remember, we're in a panic cycle year for war, you're cutting off a major portion of global platinum supply. Even a minimum 50% retracement of the platinum-to-gold ratio from current levels would represent roughly a 3x gain in platinum relative to gold. And that's assuming gold prices stay constant. If gold continues rising, platinum could see even more dramatic absolute price gains. From a pure risk-reward standpoint, platinum may represent one of the most asymmetric opportunities in precious metals right now. It's unloved, undervalued, and positioned to benefit from the same geopolitical forces driving gold and silver higher. Here's something that reveals just how significant the shift in precious metals is. The relationship between European and US banks appears to be fracturing. Historically, metal flowed freely back and forth between European banks, Deutsche Bank, Credit Suisse, and US banks like JP Morgan and Citigroup. They were partners in the system of paper precious metals trading. But recent delivery data shows something extraordinary. Deutsche Bank has been forced to deliver 3.27 million ounces of physical silver, with the primary recipients being JP Morgan and Citigroup. This isn't normal partnership behavior. European banks are being forced to deliver physical metal to US banks, who are taking it and not returning it. Why would this be happening? There are theories that US policy is deliberately pressuring European banks as part of a larger strategic competition with European elites. But regardless of the reason, the effect is clear. The smartest, most well-connected institutions in the precious metals market now want to hold physical metal rather than paper promises, and they're willing to force other banks to deliver it. When the banks themselves don't trust the paper system they created, what does that tell you about where we are in this cycle? Let's look at valuations through the lens of the gold-to-silver ratio, because this reveals just how much room silver has to run. Currently, the ratio sits in the mid-50s, meaning 1 ounce of gold buys about 55 ounces of silver. The 100-year average for this ratio is approximately 42-1. Silver comes out of the ground at roughly a 7-to-1 ratio to gold. That's the natural abundance in the Earth's crust. So right now, silver is trading 31% above its 100-year average ratio to gold. and 686% above its natural abundance ratio. If we simply revert to the 100-year average ratio of 42 to 1 and gold stays around $4,330, that puts silver at $103 per ounce. If we go to a 20 to 1 ratio, which is still dramatically higher than natural abundance, but historically has been reached during periods of industrial demand stress, that puts silver at $216 per ounce. Multiple analytical approaches, historical ratios, natural abundance, technical chart patterns, all point toward triple-digit silver, not as speculation, but as reversion to historical norms. Now, I need to be very clear about timing, because this is where most investors get destroyed even when they're right about direction. Cyclical analysis suggests we should expect heightened volatility and geopolitical events expanding significantly around April 2026. The week of January 19th shows as another potential inflection point. But here's what you need to understand. Predicting exact tops and bottoms is impossible. The sophisticated money doesn't try to time perfection. They position ahead of trends and hold through volatility. Bull markets in commodities are always longer in duration than bear markets. Why? Because it takes people a long time to gain confidence in something, but they lose confidence very quickly. Look at silver's bull run from 2002 to 2011. 8 out of 9 years were positive. The 1,970 bull market, 7 out of 8 years positive. We're potentially at the beginning of a multi-year bull market that just completed its first major up year. Will there be corrections? Absolutely. Will there be shakeouts designed to flush out weak hands? Guaranteed. But the fundamental drivers, geopolitical instability, strategic resource competition, supply constraints, industrial demand, those aren't going away. Here's something most precious metals investors don't consider. Europe's economic and political crisis is a major driver of gold demand. Europe's GDP growth has been a tiny fraction of US growth for years. They're stuck in what amounts to a socialist model that prioritizes social programs over economic efficiency. This undermines productivity, innovation, and long-term competitiveness. Some finance ministers in France and the UK have even hinted at potentially needing IMF bailouts. For major European economies to even mention that publicly means they're anticipating serious difficulty selling sovereign debt. Long-term cyclical analysis suggests the EU may not survive beyond 2030 inches its current form. There are even discussions behind closed doors about potentially jettisoning southern European countries, Italy, Greece, and Spain, and regrouping the northern economy. Why does this matter for gold? Because during sovereign debt crises, gold rises as a neutral asset. You're not betting on who wins or loses. Gold doesn't default. It doesn't depend on any government's ability to tax or repay debts. As European instability increases, capital flight into gold accelerates. This isn't speculation. This is financial survival instinct from Europeans who've watched their continent's economic power erode for decades. So let's get practical. What should investors actually do with this information? For physical holders, if you own physical gold and silver, understand that you're holding exactly what sophisticated institutions are trying to accumulate. The volatility in paper prices is noise. The fundamental value of physical metal in your possession is increasing as geopolitical competition intensifies. Don't get shaken out by short-term paper market volatility. Physical metal is insurance against exactly what we're witnessing: the breakdown of international order and the weaponization of strategic resources. For new buyers, if you're looking to establish positions, understand the difference between investing and speculating. Investors accumulate over time through dollar-cost averaging, accepting volatility as part of the process. Speculators try to time perfect entries and exits and usually get destroyed by volatility. The fundamental case for precious metals in 2026 is stronger than at any point in recent history. But timing exact bottoms is impossible. Build positions systematically rather than trying to be perfect. For traders, if you're trading futures or leveraged products, understand you're playing in a rigged game. Margin requirement increases can wipe out leverage positions regardless of whether you're right about long-term direction. The big institutions have unlimited capital and can manipulate short-term price action. Retail traders using leverage are playing with a massive structural disadvantage. Let me zoom out to the 30,000-foot view, because understanding the macro context is critical. We're witnessing the transition from a unipolar world, US dominated since 1991, to a multipolar world where the US, China, and regional powers compete for influence. China knows they're on track to become the world's largest economy after 2032. They're positioning now, securing strategic resources, building alternative financial systems, and challenging US dominance before the transition becomes complete. Russia, despite economic weakness, retains nuclear weapons and massive natural resources. They're positioning themselves as kingmaker in Eurasia. playing China and the West against each other. Europe is declining economically and politically, but still represents massive accumulated wealth that will fight to maintain relevance. In this multipolar competition, strategic resources become weapons. Gold becomes the neutral settlement asset when you don't trust other countries' currencies. Silver becomes critical industrial feedstock that you hoard to maintain technological competitiveness. This isn't temporary. This is the new normal. Great power competition where resources, alliances, and strategic positioning matter more than free markets and economic efficiency. And in that world, precious metals aren't just investments, they're geopolitical chess pieces. So what does 2026 hold for gold and silver? Based on everything we've analyzed, the war cycle dynamics, the strategic mineral designations, the supply constraints, China's positioning, Europe's crisis, the banking system fractures, and the broader multipolar competition, my assessment is we're in the early stages of a multi-year bull market driven by geopolitical forces, not speculation. Will there be volatility? Absolutely. Expect massive swings in both directions, especially around April. Will there be corrections that test your conviction? Guaranteed. Will mainstream media say the run is over multiple times before it actually is? Of course. But the fundamental drivers are accelerating, not declining. Geopolitical tensions are increasing, not decreasing. Strategic resource competition is intensifying. Supply constraints are worsening as major producers restrict exports. Industrial demand for silver continues growing. Governments are stockpiling, not selling. Sophisticated money is accumulating physical, not trading paper. Gold and silver in 2026 aren't just about price appreciation. They're about positioning for a world where the rules are breaking down, where strategic resources are weaponized, and where trust in institutions is eroding. The question isn't whether precious metals will be higher in 2027 or 2028. The fundamentals strongly suggest they will be. The question is whether you have the conviction and discipline to hold through the volatility required to get there. My job isn't to tell you to buy or sell. My job is to help you understand the forces at play so you can make informed decisions based on your situation, timeline, and risk tolerance. So here's what I want to hear from you. How are you positioning for 2026? Are you focused on gold, silver, platinum, or a combination? Are you worried about the geopolitical escalation we're seeing? What's your time horizon? Drop your thoughts in the comments. The best insights often come from the community, and I read every single one. If you found this analysis valuable, smash that like button, subscribe if you haven't already, and hit the notification bell so you don't miss updates as this unprecedented year unfolds. 2026 is going to be historic for precious metals. Make sure you're positioned to benefit from it rather than just watching from the sidelines. Stay sharp, stay informed, and remember, in times of geopolitical chaos, knowledge and strategic positioning are your most valuable assets. I'll see you in the next video.